China may allow the yuan to weaken, but how much would that blunt the impact of Donald Trump's promised tariffs? Welcome to Market Insight. I'm Elena Casas. China's top policymakers are considering allowing the yuan to weaken in 2025 in the hope that cheaper Chinese exports would neutralise at least some of the impact of the 60% tariff Donald Trump says he plans to hit Beijing with. Looser monetary policy would be the People's Bank of China's first policy shift in 14 years. A source privy to the central bank's thinking told Reuters it could ease by around 3.5%. Well, for more, I'm joined now by Janet Moy, Head of Market Analysis at RBC Brewin Dolphin. Janet, hi! Can China let the yuan depreciate enough to counteract the effect of those tariffs without triggering a full-on currency war?
Good afternoon. Thanks for having me. Well, I think it is very difficult to offset the potential tariff impact if we're talking about 60%. So I think China really has not many options, to be honest. They can stimulate the domestic economy, which they're discussing stimulus and guiding for more stimulus and looser monetary policy. But in terms of the yuan, I think the most logical way to think about it is the yuan will depreciate. But it's not going to be enough. If we're talking about, say, the speculation is it will be 7.5 versus the US dollar next year, but that's just going to be 2 to 3% weaker compared to current levels. It's not going to do much, to be honest. But if you look back at history, say for the past 10 years, the Chinese yuan is on a broad depreciation trend, and in the 2018 trade war, Chinese yuan depreciated by 14% roughly in 2 years' time. So I do think the broad direction is yuan weakness, but if you're talking about just a couple of percent, it's not going to do much. So if we see more depreciation, obviously that would trigger a currency war within the emerging market currency perspective.
Would that depreciation also risk tariffs and trade retaliation from other trade partners who want to avoid cheap Chinese imports?
Yeah, I think overall speaking, if the Chinese yuan were to depreciate further, which is very likely to be the case, I think regionally, say the Asia foreign exchange and generally emerging market as a whole, they're likely to engage in competitive devaluation or depreciation simply because if you're fighting for the exports, then if Chinese yuan depreciate, then you ought to do something similar to protect your competitiveness. So there is a concern that there could be a more competitive currency trade war that is going to happen. That is something that is going to increase uncertainty and volatility in foreign exchange market, particularly in the emerging market space. Yeah, generally, that is one reason why investors continue to be worried, cautious about the trade tariff impacts, because it's just so hard to quantify and expect what's going on. It ultimately depends on what Donald Trump is going to implement in terms of the extent and severity of the tariffs.
Janet, as you mentioned, we've already seen a reference to appropriately loose monetary policy at this week's Politburo meeting. How big of a change is what we've already seen from China?
Well, to be honest, I think since September, there has been a very clear policy signal that there would be lots of fiscal stimulus. I think that it has to be implemented in steps. I think the government is right to prioritize fixing the local government debt problem, swapping the hidden debt to official debt. So ineffective to provide more space for future lending to support the local economy. So that's a great step. And of course, various measures to stabilize the housing market, loosening restrictions for purchases, lowering the financing costs for buying property, etc. So it will take time for the actual result to show, but the primary problem is there's just too much inventory, housing inventory in China, which is going to take a long time to absorb. So I think the policy focus in 2025 has to be fiscal policy, which means ways to stimulate household consumption. And that really takes some reform and reallocation of resources, which is difficult and it's going to take a while. But I think that would be absolutely the key for 2025.
The dollar, Janet, has already been strong all this year. You mentioned that competitive devaluations across Asia could follow Trump's tariff policies. What will an even stronger dollar mean for the forex markets?
And what we observe is basically U.S. exceptionalism, thereby higher U.S. yield, higher U.S. dollar. I think that trend is likely to sustain into 2025. It's pretty much a consensus idea, but there is a lot of economic rationale for that, and it's very hard to fight that. So in terms of a stronger dollar, I think the typical implication is that emerging market currency will suffer, that it would make that debt repayment harder if it's in terms of US dollar. So generally, more difficult environment for emerging markets, and not just emerging market, but Europe, for example, Europe as well. Anyone that has a close trading relationship would suffer. But in general, I think some of that is already priced into market. But of course, that could be more volatility going forward. But generally, that is why I think investors have a very clear trade, which is bullish on US and less positive or negative, outright negative on US region. That simply is going to be the case. I think if the dollar were to strengthen much more, that could prompt some verbal intervention by Donald Trump, because he wants a weaker dollar, but it's just economically very difficult.
Janet Moy of RBC Brewin Dolphin, thank you so much for joining us. And that's your market insight. Don't forget, you can watch more videos on Reuters.com.